Okay, welcome back to Infinite Investors. Listen, it has been a crazy 2020. I created a video, can we just start this year again? The whole year it's just been on the ropes, to be honest, and I wanted to take some time out to not really talk about individual stocks here and there, but actually just to talk about the psychology of investing, and more importantly about being emotional and not being an emotional investor. Listen, this is something that I struggle with, both in a positive and negative sense, which I'm going to give you more insight to in the future, so hopefully you can learn from some of my mistakes. And then I'm going to also end the video with 9 tips of how to control your emotions when you're investing. So if you want to know all of that plus more, like, comment, subscribe, help the channel get to 5k, and we can get the world of unemotional investing out to more people in a clear, simple and transparent manner. You like what I did there, right? So listen, I'm on my Simply Wall Street right now, and obviously you guys know I'm back in the market. April the 6th has been passed, and now I'm able to invest again. And one of the things that I thought, you know what, I have to check myself, is becoming too overzealous and actually just buying haphazardly and not really thinking or staying aligned with my own strategy and so forth. So now I've got the opportunity to buy stocks again, and you can see that loads of my stocks are in the red. So now feels like a perfect time just to get investing, but at the same time we don't know how long this situation is going to last for, or how much worse. There was an article from CNBC which talked about this whole V-shaped bounce probably not going to be the case, and it's going to be more like an L shape or a U shape. And what that basically means is that it's going to drop and either curve round for a long time before it spikes back up, being the U shape, or it's going to drop and it's just going to flatten out at lower levels, being the L shape. Some people are obviously a lot more positive, some people are a lot more negative. There's a lot of different emotions at play at the moment, and so what I wanted to reframe my personal mind on is just thinking about it long term. I am a long-term investor. This moment will pass, whether it's 2 months, whether it's 20 months, whether it's 2 years, whatever it might be. This moment in our lives will definitely pass, and I'm trying to definitely see this as an opportunity in the long term. And one thing I wanted to remind you guys of is this graph of the S&P 500. This is the S&P 500 since what, 1980 through to obviously the present day. And you can see that, from 1980 to 2000, 20 solid years, it was rising at a nice and even trend. I had a little blip there, but for 20 years it was rising at a nice even trend. And then, from 2000, whole dot-com situation, it then dropped down to about 2002 where it bottomed out. That's 2 full years of it bottoming. Don't get me wrong, people probably still traded, bought and sold during this period and actually made themselves a little bit of money, but overall the market dropped for about 2 years. Then from 2002 through to 2007, 5 years just to get back to the same levels that it was in 2000. And then from 2007, or basically 8, the Great Recession, that then dropped to about 2009. So that was a bit more of a shorter, spikier drop, and that went back to the same levels that we saw back in 2002. And then from the last recession up until now, it's been doing pretty well. And you can start to see now there's this little coronavirus drop that's starting to happen, and we don't know how long that's going to continue for. It's been quite obviously a sharp drop, much sharper drops than the 2008 recession and the dot-com, and also much further back in 1929, Great Depression, and 1987 Black Monday and so forth. But ultimately there will be a bottom and out to an end to it. So I thought, you know what, let me show you this. And this is produced by BlackRock, which basically shows the emotions that people go through when they're investing. And what they've really cleverly done here is taken a hypothetical $100,000 investment in the S&P 500 over the last 20-year period, and shown you the different emotions that people go through at different stages through that. I thought personally this is just a pretty neat way just to kind of characterize and demonstrate and communicate the different types of emotions that people go through. So someone's got 100 bags and they're in the beginning in 1996, and they're like, yo, I need to go into the market. Someone says, you know what, you should put it into the S&P 500. So they're like, all right, cool. They put it in, but they're a little bit cautious, and then it starts to rise and they start to become a little bit more hopeful. Little dip, but it still continues to rise, but a bit more flattened out. They're encouraged, things are going well. Then they become positive because it rises much further, and then it has a bit of a drop, but that drop isn't even to the hopeful level, so they're okay with that. It rises sharply again, and now they're really confident. They're thinking, I've done the right thing, investing is the easiest thing in the world, and I'm going to be a millionaire very, very soon. It keeps on going up, they become thrilled, and they get to a euphoric state. Then something happens which then causes it to start to dip. And obviously, if we go back to this graph, we can see that in this instance it was the dot-com bubble. So something happens and they're like, you know what, I'm a bit surprised this has happened, but you know, it's okay at the moment. Then it gets further, they become nervous, they become more worried, it starts to bottom out, and they're just full of panic. I'm just going to stop there for the moment. There's been quite a few of you guys that have spoken to me about selling all your stocks. Some of you guys have been very transparent, which I really, really respect, about, you know, how you're feeling, you know, a little bit of panic at this current moment, maybe that you can't hack the stock market, and maybe you're thinking that this is not, you know, you're not able to take these losses, etc. You know, I always go back to the fact that I tell people, you know, make sure you have your emergency fund, make sure you don't risk more than you're willing to lose. Although you're not going to lose everything, just try and have that as a mindset. Make sure you've got savings behind you, make sure you've not got any debt, because if you have a lot of those things in place, then actually losing money becomes a little bit easier. But you know, those are one of the things that, you know, can really help. So you know what, some people, a lot of people would have probably sold around this time, and then those institutions, those hedge funds, and those, I say, more astute investors would have actually bought a lot more, bought whilst it's going down, and then definitely started buying whilst it's, you know, back on the rise, and whilst it hasn't hit those levels. So they go through the same levels of emotions again, they get to a euphoric state for 2007, 2008, and then it drops sharply. You know, they experience the same range of emotions but much quicker, they're panic stricken again, and then the same smart people decide, you know what, all of these shares are low, I'm going to start putting that money in. But it does take some time to get back to the same levels. We are talking about 2 years, I think it was, to get back to the same levels, and then from that point onwards it just keeps on going up again, and that cycle is going to repeat. We are in an our economic cycle, and by the very nature of it being a cycle means it's round, it's cyclical in nature, so it keeps coming round again and again. And what that basically means is that a lot of these things are just going to keep on happening throughout your lifetime of investing. So it's about understanding when these situations happen and managing your emotions accordingly. Now, I went across the internet just to find a good article about managing emotions, and a lot of them just talk a lot of fraff, but I have stumbled upon one. It isn't sort of a top tier publisher, but I do think it's actually got some pretty interesting information. But yeah, I did like this article, and so I wanted to talk to you about the 9 ways you can kind of control your emotions, and give you some examples that I've actually done that align with a lot of the stuff that this article is basically saying. So I'm not going to go read the article in detail, but I'm just going to talk about the headlines and then just give you my personal opinion on those areas. So number 1 is to establish long-term financial goals. I can't stress why I agree with this so much, and I can't stress enough and why this is so important. Going into the market and not having a financial goal is like, I don't know, going into a restaurant and not knowing what to eat effectively, or not even being hungry, or like for me it just makes no sense. Like, there's just no point being there. I think you need to be in the market to have a goal. It's like going to university but not knowing what you're studying, like, or any other situation like that. So establish your long-term financial goals. I talked to you guys a lot about horizon, so your time frame that you're looking for, because you know what, some people might be in their 20s and so they're looking at 30-year investments because they want to retire by 50, or they might want to retire by 45 or whatever. Some people might be 45 and they're looking to, you know, protect their income and actually generate some income via dividends. Everyone's going to be in different stages in their life, so you need to understand what your long-term financial goals are, and then finding the stocks that's better going to align to that. When people ask me questions like, is this a good stock, ticker symbol TTY, I don't know if that's actually a stock, but if that's a good stock or not, I really struggle to answer those questions, because I could simply say yes or no, but yes or no is so relative. If you are a person that might need growth, then it could be a good stock, but if you're a person that might need income, depending on your situation, it might not be a good stock. So it's all about understanding your financial goals, whether it's money, whether it's a percentage you want to get of a return, whatever your reason is, that is something that's going to be extremely important. Some people's reasons is very personal short term, it could be for their kids, etc. You know, and I think that is a fantastic reason. I talk to a lot of you guys that are investing for your children, like you're not even really thinking about yourself. It's just so that they can have their university fees paid for, etc. And so when you have a reason, I think it's extremely important, and that in the difficult and dark times, those reasons will definitely help you through those times, I believe. The next thing is to find a balanced approach, and it talks about being overconfident and being underconfident. And I think this is really, really important. You know, you have to be level-headed. Like I said to you earlier, I don't want to now all of a sudden be a bit overconfident and be overzealous. You know, I just showed you in these examples where the market went down for years. Like, we're talking years, 4 years, 5 years, 2 years, etc. So, you know, if it's gone down for a couple of months, that might be the case. It might go down for another couple of years, and I don't want to be dumping everything right now. I need to just be patient, and that is where you can potentially become a little bit overconfident in the wrong way. Sometimes you might find a stock, you might see it going up, and then you buy it, and then you actually make a bit of profit, and now you think that you know everything about the stock market, so you try rinse and repeat that with another stock, and you know it doesn't work out that way. So definitely don't be overconfident, but I think what's more important is to be underconfident and not to be underconfident. Listen, you know, don't be shook, man. You can't like be scared in the market. There is no point being in the market if you're going to be fully scared about the market. You will make irrational decisions. Not a lot of good decisions happen under fear, unless it's subconsciously, like, you know, pushing the brake on a car or whatever. But ultimately, you need to have a level of confidence, and you get that confidence by learning about the market. The more you learn, the more you understand, the more confident you feel. And when you do make a mistake, or when things do go wrong, you feel a sense of peace, because you can identify very quickly where you might have gone wrong or what's happened to affect your situation. And that's why it's going to be important. So underconfidence should be something you can all easily eradicate, but then definitely when things are going well, don't become too overconfident as well. Number 3, be completely diversified. I'm going to be completely honest. I don't fully agree with diversification. That's just my personal opinion. This is not my advice. This is just my opinion, and you feel free to, you know, to do with that what you will. I do believe diversification is a little bit of, you know, lack of confidence in yourself, and actually potentially just picking 100 stocks so that overall you kind of average out okay. If that's the case, just get an S&P 500. Get an S&P 500 that's going to have 500 stocks in there. It's going to track it, and it's going to potentially do all of the work for you. Me personally, I do like to pick my own individual stocks. I like to learn where I've gone wrong, where I've gone right, and, you know, continue that way. But diversification can help a lot of you guys be, you know, comfortable and to manage your emotions. If you've got, you know, some gold, some commodity, some bonds, some currency, some cash, some, you know, tech stocks, some healthcare stocks, some whatever, then obviously when something's going bad in one area but things are going good in another area, then actually it can make you feel a little bit more confident and help you manage your emotions. So I do think it's important. It's just not personally for me, but obviously it's definitely something to call out for some of you guys. Number 4 talks about don't be afraid to lose. I get this question a lot. How can you be so positive when you're losing money? In a lot of my portfolio updates recently, people are like, how are you so chirpy? Like, why are you like sounding like you're having so much fun when you're down 5k, etc. You can go check the comments. A lot of the comments are just there for you to see as well. It's not just things I get in my DMs as well. And me personally, like, I'm not worried about losing money. Like, a £300 on micro hard is not going to change my life, to be honest. Like, if I'm a realist personally, and generally speaking, you know, throughout the course of my life, I've lost a lot more things than £300. Do you see where I'm coming from? Not even money, not even to talk about money, just things in general, people, whoever, whatever it is. So I'm not really worried about these types of losses, and I trust myself so much that I know that if I do make a loss, then I know that I messed up somewhere. I know there's a learning to be coming from that. I need to learn what it is I need to learn, and then I need to just come back and go correct in the next time. So I'm not afraid to lose. I know there's ways that you can actually mitigate your losses by averaging down and so forth. I know the market is cyclical. Things eventually will come back up in the right place, providing you've not picked really scary, hairy businesses that have, you know, 100% debt, no equity, you know, CEO on crack, and, you know, they're just trying to make some magical materials or something. I don't know what they're doing. But if you're not invested in one of them random, scandom, wandom stocks, then ultimately, you know what I mean, you're going to probably be okay in the long run, providing that you stick it out with some of those stocks. So yeah, it's all about, you know, dust yourself off and try again. Like Aaliyah said it best, you know what I mean? And I quoted TLC in my last portfolio update. Now it's Aaliyah. It's all a 90 situation now. But yeah, that for me is really important. Don't be afraid to lose. Don't be scared when you see your 10% down, 15% down, whatever. And you know what I mean, you just need to re-understand and re-evaluate your goals, etc., going back to a whole number one situation, and then obviously have your plan of attack going forward from that standpoint. The next thing it talks about is number 5, which is number 5, use news for information, not decisions. Listen, this is a massive one. Headlines at this current moment is literally rocking the market like a swing. Headline comes here, the predictability of what's going to happen just eventually happens, and these headlines are there to scare you. I personally feel that a lot of these publications are fear-mongering. Maybe there's an agenda behind it. Maybe they want to buy things at lower prices. Maybe it just sells more of their newspaper subscriptions or their online subscriptions or newspapers or whatever it is, but there is a lot of fear-mongering as well. In the alternate way, there's certain headlines that could be done to manipulate. You know, there's a story of, you know, Bill Ackman, who basically did all of this talking in CNBC about how the world's going to end, and meanwhile he's shorting the stock market, and everyone on Twitter just basically rinsed him. And he basically shorted for 27 million, and he's made like 2.6 billion on coronavirus by shorting the market, because he's kind of made money on everyone's fear. It's a tactician, to be honest, but it just depends on which side of the coin you want to look at it. News is important. I look at the news all of the time, regardless stocks I own, stocks I don't own, stocks on my watch list, whatever, what's going on in the economy. You guys know I share loads of stuff on my Instagram and Twitter and so forth. So news is extremely important. I'm not going to sit and tell you it isn't, but you need to be able to have a filtering system. You need to be able to moderate the information that's coming to you, and when it comes, you know, you use the rational side of your brain to say, okay, I accept this information. How am I going to respond to it? Do I believe in it? Do I not believe in it? What bits am I going to take from it? What bits am I going to reject from it? Maybe I look at a counter argument and see that, and actually then have a bit more of a balanced approach and a more balanced view. So, you know, don't let the news manage you. You need to manage the news that's basically coming to you. And then obviously, you know, when it talks about it's not for decisions as well, your news really shouldn't influence your investment decisions. Some people see a news headline and then just go buy a stock because of a news headline. It should maybe trigger you researching more into that company, but it shouldn't say you see a news headline and go buy something straight away or go sell something straight away. So it can work both ways, and it's something to definitely be cautious of. The next thing is, don't be a sheep and follow the herd. You know, this is one of the mistakes I made very, very early on, way before the channel, you know, way before there wasn't even an Infinite Investors. You know, I saw my friends doing certain things in the market and I tried to jump on the bandwagon, and I lost a lot of money, and that's when it really hurt, because I didn't really, you know, plan or think about losing money in that way. And all I heard for months and months and months was how much money that they were making. So I tried to jump on the bandwagon, and I came at the wrong time and I lost a whole bunch of money. So that's the first time I ever lost money, and it definitely hurt me at that point. It subsequently hasn't really hurt me since. But don't follow the herd and don't be a sheep. You got to have your own mind, you know, your own unique perspective. There's things you're going to know that I won't know. There's things that I will know that you won't know. And ultimately, it's about understanding, you know, staying in your lane effectively, and moving forward from there. There's a quote that I heard recently: stay in your lane because there's no traffic there. And I think it's really important, man. There's no one in your lane if it's your lane. So ultimately, you need to do what's right for you, do what's right for your family, your household. Don't follow everyone else just because everyone's made this money on Tesla, or they make this money on Zoom or whatever stock, or everyone's talking about Carnival, or everyone's talking about, I don't know, AMD, or I'm talking about Virgin Money. Whatever it is, doesn't mean that it's for you. There's 85,000 stocks in the world. Trust me, you can invest in 100 different stocks. Every single person watching this channel could all invest in 100 different stocks from each other and probably all still make money at varying different levels. So trust me, there ain't no shortage of stocks. There ain't no shortage of time to invest. Just do it at your way, your cadence, and don't have to follow everyone else. So that for me is extremely important. Then it says, remove personal feelings from your investments. They don't have feelings for you. Oh, this one hurt me a little bit, because you know what? Sometimes you can get so emotionally attached to your stocks, which is something that I kind of do. And the stocks don't love you, B. The stocks do not love you. And this is basically what this is telling me. The stocks don't love me. AMD doesn't love me. Virgin Muller doesn't love me. Barrett don't love me. None of these stocks love me, man. And at the end of the day, I get what this is basically saying. You have to remove your personal feelings from your investments because they don't have feelings for you. And the thing that comes to my mind is, listen, you got to F all of that. And when I say F all of that, I don't mean a swear word, I mean fundamentals. You got to fundamentals all of that. That's the thing that comes to my mind. And what I basically mean by that is that I'm not really worried about the stock. I'm worried about the underlying information about the stock. And so if you focus on the fundamentals, things should go well. A lot of the times things have gone wrong with, as a big example recently is Lloyd's. Lloyd's has had a terrible time recently, and I know a lot of you hold Lloyd's for a number of different reasons, and so I get a lot of messages about Lloyd's. And you know, when I still look at the fundamentals, it just says to me that Lloyd's is still an investment. Now that could be naive, maybe the fundamentals is lying, but I'd rather be lied to by the fundamentals than actually do something wrong, maybe sell a losing position, and then some of you lot are going to come to me in a year's time talking about how Lloyd's has tripled in value and why did I sell. So me personally, I know why I make every decision, and it's all about removing your personal feelings for anything. And this goes in the other way as well. I try not to hold stocks just because I like this or I like that. I need to like a few factors about the stocks fundamentals wise, and then obviously I'm going to continue to hold them. And you know, when you do find a stock that maybe you liked for whatever reason, but now it's not working out, then maybe you've got to decide whether or not you need to sell that stock. But yeah, remove personal feelings. It's very hard sometimes you find a stock and you just get this emotional attachment to the stock. Maybe it's the product or service, maybe it's something that you use, and so you start to feel like, oh no, I don't want to ever get rid of this stock because I love this stock. But maybe you love the brand more than the actual business itself, and so that's something that you guys need to think about. Number 8, it talks about, remember, past performance does not equal future performance. So if you go back to the example here, you can see that things are going up for however many years. It doesn't mean that things are going to go down. Things are going down for so many years. So I can tell you that people during this period of time are thinking that I've held this stock and it went up, so it must going to be going up from this point onwards. It's going to go up, but it continues to go down, or for this point onwards it's going to keep going up, but it continues to go down. So we all know that past performance does not always indicate future performance. So you've always got to reevaluate your holdings. Someone asked me the question recently, I can't remember the question or the person, so forgive me, but it said, how often do you evaluate your stocks? Which I think is a really good question. Now I try to evaluate my stocks, I would say probably on a 6 weekly to 2 monthly basis. I'm not going to lie and say to you I evaluate in detail each one of my stocks on a monthly basis, but you guys know I do the portfolio update, so even on a weekly basis I'm keeping abreast on at least the core fundamentals and any headlines of my stocks as well. So I'm actually probably looking at my stocks more regularly than the average person just by virtue of doing this channel. But I will say that if you aren't obviously doing a channel and you just want to stay abreast, then it's definitely something that you should look into on a consistent basis, especially if you're an active investor and you're not invested into ETFs or something along those lines. And then obviously you can then figure out whether or not that the stock is doing well, etc. Alternatively, you've got the flip side of the past performance doesn't equal future performance. Just because you're interested in a stock that's done well for the last 5 years, it doesn't mean it's going to do well for the next 5 years. You've got to kind of look at some of the fundamentals that's going to help you understand the future outlook for that business. Similarly speaking, just because a stock has done bad for the past 5 years doesn't mean it's going to do bad for the future 5 years. I've been in situations where I've avoided stocks because they've done bad in the past 5 years, and in the short term that I've avoided them, they've done really well. Also, I've seen stocks that have done bad and I've invested into them, and they've done well as well because they were really undervalued. They had a bad 5-year period, but now things are going well. So listen, there's no formula. The only formula is to look at the fundamentals and then just to make a rational decision based on the data that's presented to you. Other than that, you're not going to find that if this happens, then this always happens. No, that never happens. Things always change. It's not an algorithm. It's not scientific. There is an art to investing as well. And so, you got to feel your way through some of those situations. And last but not least, it talks about be obnoxiously prescriptive and don't deviate from your method. Listen, this is basically saying that one way to control your emotions is to be obnoxiously prescriptive and don't deviate from your method, to have your plan, have your vision. I take this from two ways. If you don't deviate, sometimes it can be a negative thing. So you saw that I changed my, purely value strategy and purely UK stock strategy to have a blend of US stocks and growth stocks as well. So I think that's had a very positive impact to my performance. But at the same time, I've also been able to, deviate from my strategy by going towards more US stocks and actually, looking at different opportunities there. I think what this is basically saying is that when you don't deviate from your method, it means you have your plan and you stick to it, which I fully agree with. But I will also just add to this and say I agree with it partially, but also be flexible. Maybe your initial plan was wrong for whatever reason and it's time to tweak. I've sold loads of stocks, and a lot of the stocks that I sold is because it just didn't really stick with, what I started to see afterwards. I wasn't really happy with what I was seeing originally when I bought it, so I decided to change tact on that. But yeah, I hope you found this video useful. It was a lot longer than I actually expected it to be, but you know what I'm like already, man, so stop complaining. But listen, hope you found this useful, and ultimately controlling your emotions when investing for me is probably the second most important thing, bar the fundamentals, when it comes to the stock market. So I thought it was really important to do this video at the time. The fundamentals is the most important thing, looking at the different fundamentals of your stocks, but also making sure that you don't that you're able to control your emotions is really, really important, because emotions is definitely going to drive you in multiple ways. So yeah, I hope you found this video useful. Like, comment, subscribe, and I will catch you next time with another investment video. Peace.